Just a quick introduction. I'm Kirsty. I'm a senior manager in the entrepreneurial tax team here at Shin & Tate. And I'm just going to give you a quick run through some of the basics of SEIS, EIS and share schemes. And I'm also going to bring in some examples. Our partner of the team, Neil Norman, is also here, and he's going to bring up some of his war stories, different things that we've seen in different situations, and things generally to look out for. As I said, I'm really keen for this to be as interactive as possible, so don't hesitate about just asking a question. If you use the raise hand button, Stuart will keep an eye out and make sure that you're unmuted so that you can just pop up. I'm super happy to be interrupted at any point, so I can make sure I'm covering off everything you want to hear. So first of all, I'm just going to share my screen and pop my presentation up. So we'll start off with SEIS and EIS. Most people will have heard of this, I hope. It's the tax advantaged relief available to investors who are investing in startup, high growth companies. SEIS is for smaller, earlier stage businesses, and EIS is essentially the follow-on relief for companies slightly further down their journey. Essentially, the plan is that HMRC look for investors to mitigate risk when investing in these kind of early stage companies by giving them tax relief on their investments. There's two different rates, and I'll talk through that in just a second. There's no actual tax impact for the company. It's purely the benefit of the investors, but it enables the company to get that investment in the door and to have their investors on board. So you have to be an eligible company to qualify for SEIS or EIS. There are certain requirements that you have to meet, and they will be questioned at the point where you take investment, where you have to follow the compliance set out by HMRC. First of all, you have to be an unquoted trading company. Most early stage companies would be. It is possible to be AIM listed if you're further down the journey and you're looking to raise a significant round, but otherwise listed companies do not qualify. The company also has to have a permanent establishment in the UK. So essentially you need to be based in the UK, doing something, trading in the UK, have management in the UK. Quite a lot of companies we've seen recently who are based abroad, whether it's America, whether it's the EU, will look to incorporate in the UK and set up over here because there's so many tax advantages, there's such a good entrepreneurial ecosystem, and that is perfectly achievable. We've advised on many situations like that. It can sometimes be a bit more complicated trying to get everything set up with Companies House and HMRC. Neil, we actually had a situation recently, didn't we, where a company was trying to get a permanent establishment set up, and it took a bit of time and a bit of effort, but we got there in the end.
Yeah, it's harder work to establish a permanent establishment in the UK than you'd think. I suspect most companies on the line are already here.
Nice and easy. The company also has to be undertaking a qualifying trade. So there's a whole list of trades that are disqualified, things like energy generation, running a hotel, accountancy and legal services. What else is there? Nursing homes. Certain things are on the list, but there's exceptions. So the receipt of license fees. So if you have a product, you have IP and you license out your product to other businesses, you might not qualify. But if you've generated all of that IP yourself and created the majority of it, then there's an exception that you can fall into. So it's something that needs a bit of close review when you're looking at applying for either advance assurance or when you're looking to take investment. But generally, most of the companies that we look at and that are especially in the tech area would normally qualify. There's also a requirement about control and independence. So this comes into play if a company is looking to take investment, if there's already a corporate shareholder, so another company, that company cannot be able to control the company that's looking to take investment. If the company looking to take investment has subsidiaries, they also have to be controlled by that company. So you've got to make sure that they have 51% of the share capital and also full control.
Just chip in on this. This is a major point that comes up again and again. Perhaps not at the stage your businesses are currently at, but if you take investment and you grow, it is entirely possible, maybe even probable, you'll get to a stage where someone will come along and say, I'd like to do something with your company. I would like to do a joint venture. Joint ventures, you don't get 51%. Typically, you get 50. Or we would like to, we'd like you to take a minority stake in a company. That's the same thing. You can't be in that position. You must have control of subsidiaries.
Definitely, it's a really important point, and it's a point that we look at time and time again, and it's also really important for EMI. There's some similar rules going on across the board when we're looking at EMI and EIS, so quite often if we're looking at something for EIS, we'll pop in a comment and say you should be thinking about this if you're going to do a share scheme as well. The age of the company is also actually really important. So for SEIS, it can't be more than 2 years old, the trade that is. So say, for example, you've got a company that you've had running for a while, and maybe you've done some bits and pieces of consultancy work and you've taken receipts, you've taken payment for services 3 or 4 years ago. If you were then to undertake your new actual trade that you're looking to build and grow and use EIS to develop, SEIS to develop, then if that receipt was taken more than 2 years ago, then that would disqualify you for SEIS. So it's really important that it's a new qualifying trade. For EIS, it's slightly more complicated. Again, it depends on what you've been doing in the past. If it's a new company that hasn't started trading yet, hasn't taken any, hasn't made any sales essentially, and it's all kind of very straightforward, then that's you're fine. But if the company's been going for 7 years and you made your first commercial sale more than 7 years ago, there's a couple of different exceptions that you can look at to see if you could qualify. Things like, are you creating a new product? Are you entering into a new geographic market? Now, we've had a couple of situations with HMRC where we've tried to argue this point, and it's certainly not the easiest one to argue. They ask a lot of very particular questions about, why is it a new product? Who are your customers? How has this changed from what you were doing before? Is it a completely new service line? Is it just associated with what you were doing before and it's a slightly different angle? Looking at geographies, have you done any kind of testing of that market? Okay, maybe you've started there and you've not done very well, but now you're looking to do a lot more. So there's a lot to consider, and this came in I think November 15. Neil, correct me if I'm wrong.
You're right.
And since then, it's become a huge consideration for lots of companies that we look at. Some of the companies that have been taking EIS investment for quite a while, they qualify because they took EIS investment in the first 7 years of their trading activities. That was fine, that gets them across the line. But some companies, like I said, have been developing a product for years and years, they've been trading, doing really well, but then they've noticed a different part of the market that they could get into, and the funds that they have in the business just aren't enough to get them to where they want to be on that new service line or product line or whatever's happening. So trying to argue that with HMRC that they can use EIS investment to get them there, because they wouldn't necessarily get funding from someone like a bank or a debt funder. And EIS is the only opportunity because it's so high risk. Business angels want to get involved and will support it because hopefully it's going to do well in the end. So it's a really important point to consider. Like I said, it can be really straightforward if it's a new company, nothing's happened in the past and you're just starting out in the journey. It's a kind of tick box, but it's definitely something to consider if you don't fit into that situation. There's also limits on the size of the company. Again, if it's an early stage startup, normally these boxes will all be ticked, but you have to meet a certain gross assets test. You can't have more than a certain number of employees. In most cases, we don't see the employee limit being blown at any point, or the gross assets even also. But also, if a company has taken Series A rounds, then maybe we have to start considering that. Depends on the nature of the business as well and what they're doing. And there's also limits on the total amount of investment raised under each scheme. So, like I said, SEIS are for the earliest stage companies. So they can take up to 150,000 at any point. It's a maximum lifetime limit of £150,000 under SEIS. But then you can go on to take EIS funding instead. And you can get up to 5 million a year or 12 million across your lifetime. And if a company is what we call knowledge intensive, which basically means that you are developing IP, you're probably doing research and development, and you have certain qualified staff who have degrees, master's degrees, things that fall into a category where they're required for their jobs, you can qualify as knowledge intensive, and that just increases the limits a bit more. So although you've only got the limit of 150,000 for SEIS, it's possible to do 2 rounds at the same time. If you need to take more than 150,000 and you want your investors to get the benefit of SEIS, but then also get EIS. SEIS, the income tax relief is 50%. EIS, the income tax relief is 30% on the amount of your investment. So obviously investors are going to want to make use of that 50% tax relief as much as they can. It's really important in this situation though, that SEIS is taken on day 1 and EIS is taken on day 2.
Can I just chip in at that point, Kirsty? So, here's a war story. So there are 2 requirements around tranched investments. One is, as Kirsty explained, that you can't take it all on day 1. You have to split it over 2 days. You do the SEIS first, you do the EIS second. There is, however, and that rule is pretty well known now. There is, however, a second rule which comes back to, as Kirsty was saying, limits on the size of the company. There's a gross assets requirement for SEIS of just £200,000. So let's say, in fact, you know what, I'm going to give you the exact facts of a scenario we looked at. A company took £500,000. That is really common for a first raise. Took 150 under SEIS, it took 350 under EIS. They didn't do it right. They took the whole 500,000 into the bank. They then issued the SEIS shares. On day 2, they issued the EIS shares. The problem is, on day 1, they had 500,000 in the bank. That is in excess of the £200,000, and thus they broke the SEIS gross assets limit. Now, it wasn't a complete disaster. It wasn't mitigated in so much as that first day's investment, which is no longer SEIS qualifying. We could go get EIS on, and we did. But on that £150,000, the income tax relief was then 45,000, not 75,000, and the investors lost out on £30,000, which was a rather embarrassing conversation for the company to have. These are the facts, but it's not the first time we've seen it. We've actually seen it quite a few times. So if you are in a position where you're going to take an SEIS and an EIS round, be aware there are 2 rules, not just 1 you need to contend with.
Nothing's ever straightforward, is it, when it comes to tax? The company also has to meet the risk to capital condition, which came in a couple of years ago. This is another kind of EU state aid based requirement, but it's now been written into domestic law as well. So the risk to capital condition is basically making sure that these companies are high risk, that the investors don't have any kind of risk mitigation involved in things like the share rights or the nature of the trade. So for example, HMRC don't want someone to invest in a company which says it's undertaking a trade, but then also if you look at their balance sheet, they've got loads of assets in there, whether it's, I think an example Neil used before was a pub, where they're trading as a pub. That service line in itself might be risky. You don't know if it's going to work, if a startup of a series of bars, for example, are going to work. But then if that's supported by the fact that they own the properties those pubs are run from, you're less likely to have the same risk because you've got that value sitting there in the property. And that's
that was exactly the kind of scenarios that Revenue tried to stop when they introduced their capital condition. Before it was there, to avoid property development rules, there were some rather unscrupulous structures set up where funds were investing in disused pubs, turning them back into pubs and then selling them on. It was basically a property play. There was a film investment scheme that was out there, which guaranteed a 95% return on your investment. Now, who would want a 95% return on your investment? Well, the answer is someone who also gets 30% from HMRC. That was the explicit purpose of the investment scheme. You give us 100 grand, we'll give you 95,000 back. But don't worry, HMRC will give you 30. You're up to 125. We all win. Now, it was that kind of rather distasteful scheme that they were looking to stop with the risk to capital condition.
And it certainly has been. It's one of those conditions now that we have to be very explicit about everything going on in the business to make sure that HMRC understand every aspect and can make a reasonable judgment. Obviously, when we submit applications, we're confident in our assessment that it would meet the risk to capital condition, but it's certainly something that HMRC will look at very closely, and it's certainly something important to be considered.
For the benefit of the listeners, it's don't sit there feeling comfortable because you're not running pubs or films. This is my least favorite EIS legislation ever enacted. It's my least favorite because as a tax advisor, I like to look at the legislation, look at the case law, look at the scenario, and see how one applies into the other. This is subjective. This effectively grants the inspector the power to look at the factors and decide for themselves if, on the whole, it's risky enough. Now, that doesn't work for me so well. And they look at a whole range of factors, not just assets or what someone's going to get back. They might look and see, well, actually, is your business going to develop and grow enough? Are you going to hire more staff? Are you subcontracting out the work? Subcontracting in and of itself isn't a disqualification event, but if you're not undertaking it enough, they might decide that it's not risky enough. Whether you agree with that is irrelevant. They look at whether the business has been fragmented. Have you taken a qualifying and a disqualifying part and sort of stripped it out? They look at the current ownership. And very importantly indeed for everyone on this is they look at your investment memorandum. They look at your business plan. They look at anything you've provided to investors, and they look for any indication of there not being enough risk. We saw a case last year where a company had complied to the letter with how you can have preferential rights for EIS investors. Very common to say, investors are putting in £1 million. The first £1 million goes to the investors in the event of a company sale. Now, if it's written exactly like that, they would fail for another reason. But it's structured in a way that is permissible. So on the first £1 million, 99.99% of £1 million goes to the EIS at the same time as everyone else gets 0.01. That actually meets the requirements. However, because the investment memorandum said we are de-risking your investment by doing this, they said you fail the risk to capital condition. There is only one reason that preferential rights on assets are ever there, and that is to de-risk. This is the only reason. But because it was made explicit in the business plan, that killed the investment. So be very careful, everyone on the call, when you're looking at what information you're putting out to your investors, not to say something that HMRC are going to find distasteful to the point that they say, nah, don't like it, you fail the risk to capital condition.
Thank you. So the actual investors themselves also have to qualify. There's certain rules about connection with the company. So say, for example, if someone wanted a family member to invest, it goes in a vertical line. So if I had a company, I owned 100%, or even if I owned, say, 25%, and I wanted my dad to invest, he wouldn't be able to get income tax relief on his investment because he's related to me and because together we could own more than 30% of the share capital. If I wanted my sister to invest, she could invest. She's not related to me in the vertical line, so it's absolutely fine. We quite often see people saying, okay, well, my brother-in-law or some kind of more distant relation wants to get involved. That can be factored in, but parents and children, grandparents in fact as well, cannot. An investor also can't have an existing shareholding in the company unless it qualified for SEIS, EIS, social investment tax relief, or venture capital relief, or it's a subscriber share. So subscriber share is basically you acquired under incorporation and that's the only thing that you have. I'm actually looking at a case at the moment where an individual had subscribed for shares in a previous round under EIS, but at the same time got shares as a finder's fee, essentially, for bringing in other investors. And because part of his shareholding qualified, because he had acquired it fully in cash, he'd met all the requirements, but then about 5% of the rest of his shares didn't qualify because he didn't meet all the other conditions. His current EIS investment will no longer qualify. So he's just put £100,000 into the business and he's not going to get any tax relief on that. It's something that people don't always necessarily think about, but it's another really important point.
And for those listening, you're all running companies. It's very common in your articles to have good leaver, bad leaver provisions that would apply that if you have an employee or director shareholder who is going to leave the business, that their shares get taken off them. Usually in that situation, those shares will be taken off and one of two things will happen. They'll either be bought back by the company or they'll be bought by the other shareholders. And if they're bought by the other shareholders, let's say you have a scenario where you have already 10 EIS investors in your company and all 10 say, that's fine, I'll take up my right and I'll buy the pro rata element of the shares that are for sale. All 10 of them now hold their EIS shares plus non-EIS shares, and every single one of them can't invest again. So be careful for that.
Investors also can't have any linked loans. So there can't be a deal whereby they invest in the company and also under the same agreement or whether it's formal or informal, I guess, provide a loan to the company as well. Obviously, there can't be any tax avoidance involved. It's a general rule with anything with HMRC, just no tax avoidance, but obviously everyone's trying to follow the straight and narrow and just get the investment that they need rather than trying to get their investors to avoid tax. And then there's limits on an individual's investments. So under SEIS, an individual can invest £100,000 a year. Under EIS, it's £1 million, unless it's a knowledge intensive company, as I mentioned before, and that limit is doubled. But the extra £1 million has to be invested into a knowledge intensive company. And then just some other general requirements to run over. The shares have to be ordinary shares. So you can have ordinary shares. You can have obviously preference shares. Preference shares do not qualify for EIS because you are guaranteed some kind of return. And the ordinary shares can't carry a preference as part of the rights. So as Neil was mentioning before in the risk to capital condition, if in the articles it says the ordinary shares, the EIS shares, automatically get £1 million back before anyone else gets anything if the company is sold, that would be a preference. And that's a timing preference. So if there's a rule that says the EIS shares get first, the other shares get second, that wouldn't qualify. But we do have a lot of situations where the EIS shares will get 99.9% of the price they paid. And at the same time, the other shareholders will get 0.1% of the price they paid. And then it'll go vice versa. And that works. I don't know if it'll necessarily work forever, but HMR seem to be accepting at the moment. Although, like Neil said, if that's mentioned in a business plan saying you're going to get X, Y, Z, you're going to get your money back, then that would probably fail the risk to capital condition because the way that you've promoted it has been as a de-risked investment. You also can't have any pre-arranged exits. So if you were to start the company and then take investment and say, okay, we've actually been working with, say, Facebook for the past 6 months, and they're planning on acquiring us in 6 months, then you wouldn't qualify. The company can't issue EIS shares at that point because already an exit in place. There also can't be any rights in the articles where it says an EIS investor can have an automatic exit at a certain point. Say, for example, if they want to sell their shares, the company will always automatically buy them back. If there's an obvious route written down or agreed whereby the investor can sell their shares and make their money back, that's classed as a pre-arranged exit. Growth and development. This was mentioned in risk to capital as well. I just saw Tim's popped up with a question. Is there any benefit to non-residents. Sorry, 2 seconds. I'm just going to open this up. Tim, I'm happy to put your microphone on if you want to just pop up on screen.
Hi, sure, yeah. I'm sorry if this is the wrong place to ask the question, but
All right.
it was just around participants. For non-UK residents, is there anything at all, any benefit for them in taking part in either of the schemes, or can they? Is it possible?
So I'll take this. Anyone can be granted an EIS 3 if they're an individual who meets all the conditions. And it's not until they've got an EIS 3 in their hand that they can actually claim their tax reliefs. Now, a non-UK resident is unlikely, but not definitely not subject to UK tax. They're unlikely to. If they live in, say, France, they're going to pay tax in France. But if they held, say, property in the UK and they had rental income from the property in the UK, they'd have to pay tax in both France and in the UK. They pay in the UK on that property income. So that individual based in France has a UK tax return. They could make a UK tax claim. That would mitigate their tax. Another situation which we do see from time to time is an individual with a little bit of UK income, but who might be British, who's going to come back to the UK. They're outside the UK fiscal system at the moment, or predominantly outside, but they're going to come back. And they're going to come back at a time when they think these shares will be sold. In order to claim a tax-free disposal of their shares, they need to have claimed income tax relief on the way in. So sometimes it's worth structuring, for the right individual, it's worth structuring them to have some income in the UK to pay tax on it if they know they're going to come back into the UK, because one day they're going to sell their shares, and that's how you get your tax-free disposal. Generally speaking, though, if an individual is outside of the UK, they're outside of UK tax, and they can be granted an EIS 3, it's just of absolutely no use to them whatsoever.
Okay, cool, thank you. It's US residents are thinking about it, so it's probably not going to do anything for them.
No, it's not. And the US is particularly difficult because unlike most countries, the US says if you're in the system, you're in the system forever. So even if in my scenario you had a US resident who moved to the UK, they'd still be subject to tax in the US and potentially won't have to pay capital gains tax or the equivalent in the US when they dispose of.
Okay, cool, thanks.
No problem. So yeah, growth and development is basically the company has to have plans to develop and grow their business, develop and grow their trade, whether that's hiring new staff, making greater sales, developing into other geographies, expanding the product range. You've just got to be able to show in your business plan that your plan is not just to stay stagnant. You're not taking money to keep doing what you're already doing. You're taking the investment to actually build a bigger, more successful company. And in most cases, people will be doing that. People will be looking for a nice sale at the end of it in a few years' time. So this is one of the easier things to meet. It's just got to be shown in the business plan that we submit to HMRC. And then the money that's raised has to be employed on qualifying activities. So if a company is undertaking a qualifying trade, then in most cases, the money will be employed for those qualifying activities. If the company does something else or has other activities that maybe aren't on the qualifying trades list, or are on the disqualified trades list, I should say, then that wouldn't be qualifying, that money wouldn't be acceptable. So there's certain things that you can't do. You can't use the money to acquire another company. You can't use the money to acquire IP that has been used in another company or assets. So I think we actually had a situation recently that we were advising on where a company was looking to invest into another company based in China. And we were advising them on how they could get the money into this company, get the money to the director so that he could get match funding from the Chinese government to be able to build their product in China and get to where they needed to be. We managed to kind of get a bit of a workaround in place, didn't we, Neil? So that they could do this, because lending technically is a disqualified activity. So using EIS money to lend out to do something different could be an issue. If the company was a 90% subsidiary, it wouldn't have been a problem because you can pass money down as long as the company owns at least 90% of the subsidiary. But this was only going to be maybe maximum 51% subsidiary. So there was a few issues there. In most cases, we see the company is raising money to be spent on the qualifying activity, whether it's spending on R&D, spending it on new staff that are being brought in, marketing, PR, things like that. And then this is just a quick summary of the tax benefits. So as I mentioned, SEIS, 50% of your investment back as income tax relief. Obviously, you need to have actually spent or paid that amount of money as tax to HMRC to be able to get it back. EIS is 30% and knowledge intensive is the same. For SEIS, there's an added benefit where you get a capital gains tax reinvestment relief. So if I had sold an asset and I had a capital gain sitting there, if I used the gain that I made from selling that asset and invested into an SEIS qualifying company, I could exempt part of that gain, 50% of that gain, from capital gains tax. And I won't ever have to pay 50% of my capital gains tax bill, which I think is a pretty good deal. For EIS, it's just a timing benefit. So you don't get to exempt part of the gain, but you get to defer it into the investment that you're making. And then that would come back into charge when you sell the shares in the EIS company. Obviously, if you keep reinvesting into EIS companies, you can keep saving that tax, and eventually one of two things will happen, and it's a bit morbid. Either you will have to pay the tax and not invest any further, or on death, the gain would be extinguished. And finally, the big ticket for most investors is that when you invest in an SEIS or EIS company and you've claimed income tax relief on the way in, you get a capital gains tax exemption when you sell your shares. So rather than paying 20% of your gain as capital gains tax, you will pay absolutely nothing on sale and you get to keep your full proceeds. And then the compliance requirements, which is the key part of where we come in. Advance assurance, you may or may not have heard of. It's a really important part of the process. As you've heard, we've only kind of touched quite lightly on a lot of the technical points of SEIS and EIS. But advance assurance enables you to go to HMRC and provide all of the facts of the company and say, look, this is what we're doing. These are our plans. This is why we think we meet all of these different requirements. Can you please let us know that if we were to take EIS investment or SEIS investment, that you would agree and that you would approve our application. And so you take that ahead of getting investment. You take that once you've got investors who are interested, because HMRC won't accept any speculative inquiries. So they want basically a short letter or indication from an investor that they're looking to invest in the company and they're quite serious about it, because I think it was about 18 months to 2 years ago, they were so overwhelmed with advance assurance requests from companies who actually weren't then going on to take investment, and it was taking up so much inspector time that then waiting times had got up to well over 8 to 12 weeks at one point, hadn't they, Neil?
On complex cases, it was nearly 16 weeks at one point.
Yeah. And as you can imagine, if you're looking to take investment, you don't have necessarily 16 weeks to wait to get that money in the bank. You're looking to do it immediately. So waiting for HMRC to turn that around was quite a pain for a lot of companies. The waiting times are much faster now. We actually had one turn around the other day in 2 days. I'm going to claim that it was the quality of the claim and we'd just written it so well, the inspector was chuffed, but it was a Friday afternoon and I think he was just bored. So that is the first stage. It's really straightforward. Send it into HMRC, they approve it, they come back, and then you've got that knowledge. You can pass it to your investor and say, look, HMRC have said that we would qualify if we were to submit the compliance statement once you've invested, and it gives them that kind of bit of security that when they invest, they're going to get their tax relief. It's not a guarantee though, that's the key point, but it is just assurance as it's called. Then you'll go ahead and take the investment. And once you've taken the investment, and only once that money is in the bank and the shares have been issued, we can complete an SEIS1, which is the compliance statement to say who's invested, how much they've invested, and when it was done. If you don't do an advance assurance, then at this stage you have to submit all the same information that HMRC will require. And the main risk here is if you wait till the SEIS1 and don't get an advance assurance, you've got the investor's money in the bank, they've got their shares in the company, and if HMRC then find out something at that stage that they don't like, then they're going to come back to you and you're going to have to explain to some pretty disgruntled investors that they don't get their tax relief. So especially if it's, well, it doesn't matter, 50% or 30%, they're not going to be overly chuffed to realise that they're still going to have their tax bill at the end of the year and they've paid the full whack for their shares, and they're not going to get a capital gain exemption when they sell. We've seen a few of these situations where things like that have happened. Sometimes we've been able to argue with HMRC and say, no, these are the facts. We may not have got advance assurance, but we've drilled in, we've given them a good argument, and we've managed to get it through. But it's not always the case. So on the basis that HMRC do approve the SEIS1, they'll then go ahead and provide the company with something called an EIS2, which is basically something you keep on file to say, you've submitted an EIS1, HMRC were happy with it, the company qualifies, your investors can get their certificates. Those certificates are the EIS3, and that's basically just what the investor uses to apply to HMRC to get their tax relief. And that's the end of the process. When it's done properly, it's really straightforward. It does take a bit of time to get everything through HMRC and agreed, but there's inevitably things that can go wrong, and HMRC might come back with questions. The inspectors are very thorough when they look at these things. There's not an awful lot that goes unnoticed, so more detail is always the best way forward. I'm going to stop for a second and see if anyone's got any more questions before I move on to share schemes. All good? Cool. So I'm going to focus on the main share scheme that we see, which is EMI. I think last time I checked, we're working on about 15 or 16 live EMI schemes at the moment. It's just something that's completely taken off, especially during the pandemic. I think because a lot of companies are obviously tightening belts and thinking, can I afford to be paying bonuses? Am I going to give someone a pay rise? Or actually, should I just implement an EMI scheme, get them share options, and give them that hope that they're going to get something or an exit in the future? I can keep them in the company and hopefully they'll stay happy. So the key point of this essentially is to attract, retain and incentivize key staff. So it may be new engineers, it may be a new CEO, it could be a new CFO, it could be someone who's coming on to work at any level of the business. Essentially, they have to meet certain requirements, but I'll talk through those in a second. Basically, an EMI scheme is used to issue options in the company to employees. So basically a piece of paper saying, here's an option, at some point in the future, you can exchange this, pay a price, and you will get shares in the business. But EMI is really tax efficient. It means that you're not going to issue shares on day one that will inevitably have either a price attached, which people can't always fund, or if they don't pay anything for them, potentially a tax charge, which again, they can't always fund, and they don't know that they're going to get anything back from it at the end of the day. So this is quite a good safe bet for both the company and the individuals to get shares into their hands in the future, or just to get them some proceeds of a sale if you want to make it exit only. You can also do a non-tax advantaged share scheme. When I say non-tax advantaged, it's very non-tax advantaged. It's much more expensive. The individuals will have a significantly larger tax bill, and we highly recommend that anyone who can implement an EMI should definitely do so, because it saves everyone a lot of tax. There's a couple of other ones as well that you don't necessarily see so often. A company share option plan, you can only issue a much smaller amount of shares, but there's no disqualified trades list. The disqualified trade list for EMI is pretty similar to the EIS list. A CSOP, we've seen them in some situations for places like maybe an accountancy company that is looking to incentivize employees, but they don't qualify for EMI. We've also got the share incentive plan, which is for normally quite significantly larger companies. You have to have something called an employee benefit trust in place. There's 4 different types of shares that you can issue. There's a lot of admin, and it makes sense for certain companies, but for high growth startup, definitely always stick with EMI. And then save as you earn is something that we don't see very often at all. In fact, I don't think I've ever heard someone ask me about it before. And it's basically a way to save using shares, but not very popular in this neck of the woods. And then something we do work on quite a lot is long-term incentive plans. You can use things like growth shares, where there's basically a value set where the holder of a growth share won't be entitled to any of the value of the company until it reaches that level. And then they get to share in the proceeds above that level. So we do quite a lot of growth shares at the moment. A lot of our companies are at a kind of further along stage where they've done EMI several times, they're gearing towards an exit, and they're thinking, right, how am I going to get the best out of my employees over the next 4 years? Okay, I'll give them a growth share. But you can also do long-term incentive plans with things like cash bonuses, things called a phantom share scheme, which is basically looking at the share value and then giving a cash bonus. There's lots of structuring kind of different opportunities to be quite flexible with an LTIP. But like I said, they are for normally larger companies looking towards an exit, and inevitably they're more expensive to implement and have more tax implications associated. EMI though, it's extremely flexible. You can basically think, okay, do I want to give this to every employee? Do I only want to include certain employees? Maybe I only want to include the ones that have been part of the company since the very beginning and they've worked super hard and they've sacrificed an element of salary where they could have worked elsewhere and had a higher salary or had bonuses. You can also decide if people will have to meet certain performance conditions. So do you have to stay with the company for a certain amount of time? Is it aligned to our appraisal process? You can kind of make it up as you wish, and you just need to be able to communicate that to your lawyers so that it's all written into the option agreement. As I said, it's the most favourable tax treatment, and I'll explain that in just a minute, and most small companies will qualify. So in terms of the company requirements, not too dissimilar from EIS. You've got to have less than 250 full-time employees, less than 30 million in gross assets, and like I said, you have to be carrying on a qualifying trading activity, which is pretty much the same as the EIS list. So if you qualify for EIS on the basis of trading, you're most likely to qualify for EMI as well. One of the kind of trip-up points for employees, however, is that they have to meet the working time requirement. So they have to work at least 25 hours a week in the business or spend 75% of their total working time at the company. So if you've got full-time employees, it's completely straightforward. If you've got individuals who work part-time in your business and part-time somewhere else, then this might be a bit more of an issue, and you have to consider whether they're meeting 25 hours a week or whether it takes up the full 75%. An EMI option also can't be given to someone who already holds 30% of the shares in the company. So if you're looking to rebalance shareholding, someone's already got 35%, but you want them to get 50%, because it should have been set up differently at the start, then you can't use EMI because they already hold that 30%. It is something that we quite often use though, if founders have set up the company, started off on their journey and then realised that actually a key individual should have had a greater shareholding in the beginning, then we'll use EMI to kind of rebalance the shareholding position in a tax efficient way. Otherwise, they can end up with what we call a dry tax charge. And an individual can already hold more than £250,000 worth of EMI or CSOP options. And that's based on the value that we agree with HMRC when you grant the option. So the tax benefits for employees. On day one, I would, if I was the company director, I would grant an option to my employee. Like I said, it's basically a piece of paper saying at some point in the future, you can acquire some shares. So there's no income tax or national insurance when you grant the option. And there's normally no income tax or national insurance due when you exercise the option and acquire your shares, but that's completely dependent on how much the individual pays to acquire the shares. So when we do an EMI scheme for our clients, the first thing we do is evaluation, and we agree a value with HMRC. When we go to HMRC, we basically assess what's happening in the business, what's going to happen in the business, and we say, this is what we think these shares are worth. once we agree that value with HMRC, we'll then let our client know, and they'll decide, do we want our staff to pay the price that's been agreed with HMRC, the market value, or do we want them to pay less when they exercise their options? If they pay the market value on exercise, then there's no income tax or national insurance. But if you pay less, then you'll pay income tax on the difference between the price they paid and the market value that we agreed, which could have been 5-6 years ago. So there's still a massive benefit because they're not paying tax on the price on the day of exercise, but on the price, the value of the shares potentially some time ago. If the options are exercised on an exit, then they get classed as something called a readily convertible asset, because someone is looking to buy those shares. They can be easily converted into cash. I'm going to hand them over. Someone's then going to give me cash immediately. And in that situation, it's not just an income tax charge, it's paid through pay as you earn, and national insurance contributions are due as well. And then on the sale of the shares, obviously when you sell a share normally, you will pay capital gains tax. On EMI, there's a bit of an added benefit in that you can get business asset disposal relief, commonly known as entrepreneur's relief, at 10%, provided you've held the shares or the shares combined with the options for at least 2 years. So in effect, if the individual pays the market value to exercise their shares and then sells them immediately, although they've had to pay the price to exercise, their tax charge will only be that 10% tax charge. On an unapproved option, you would grant the option on day one, maybe they're going to exercise it 5 years later. They then get taxed on the value on the day that they exercise. So although they've been granted it maybe when they were worth £1, but exercise it when they're worth £10, they'll pay income tax on the full value of that day, less whatever they've paid. And then they'll pay capital gains tax when they sell the shares in the future at likely 20%. So there's quite a big difference between the tax treatment of both. And then for an EMI scheme, there's actually a company benefit as well, because the company can get a corporation tax deduction based on the value of the options exercised, less the payment made by employees. Now, when a company is being sold, this is quite often a really important part of the liaising with the purchaser and agreeing who gets to have the corporation tax deduction. Because if you've got lots of employees with lots of EMI options and they've held them for a while and the valuation has increased significantly, there's quite a huge deduction to be taken. And Neil, I think this is quite an important point that you look at when we're advising on company sales.
Yeah, it's a massive point. On many deals I've worked on, it's been the biggest point, is who gets this benefit. Because you've got individuals that are getting shares for almost nothing, that might be worth, it's quite reasonable and quite common for a high growth startup to be sold for maybe 20 million. Maybe there's 15% of their shares under option. So you're talking £3 million worth of shares. The tax deduction on £3 million is worth about £600,000. So a big point in deals is who's entitled to that? Is it the seller of the shares, or is it the buyer of the shares? Because the tax relief will only come in once the company's been bought, but it's only come in because someone's exercised their share options. So it's a really important point, and for I think everyone on the call is running a business and would therefore be the seller of shares. It's a really, really important point. If you find yourself negotiating heads of terms one day, and I hope you do, right up front to lay claim to the benefit here, and to ensure that that benefit comes in as at least as a protection against any claims brought against you after you've sold the business, but ideally as additional consideration.
So like I said, it's a nice little benefit as part of the EMI, as well as incentivizing your employees. The company can get some cash back as well. So in terms of EMI reporting, there's also an advance assurance process available to make sure that the company qualifies. Some companies think it's not worthwhile, especially if they've taken EIS investment, but we always say that it's really important, especially in a due diligence exercise. Again, we're getting to that point if the company is being sold. the advisors on the other side will come in and they will ask to look at everything in the business. And especially if there's EMI, it's something that gets crawled all over. If I'm doing a due diligence on another company, I will go all over their EMI options and make sure that they tick absolutely every box. So an advance assurance is a one-off piece, and then you just pop it in a file and keep it for the future, and it'll make the tax advisors very happy when you are able to pull out on sale. Then you can get the valuation from HMRC, or you can do that actually at the same time. Advance assurance tends to take a bit longer than the valuation, but at the moment, like I said, the advance assurance team seem to be working pretty quickly. The valuation team seem to be slowing down, but we've seen significant increase in the number of valuations we're doing recently. So I can only imagine that they're as busy as we are. So like I said, we value the business, work out how much the shares that are being issued under option are worth. And then you've got, at the moment, 120 days to grant the options once the value has been agreed by HMRC. Previously, it was 90 days, but then as part of COVID, they increased it to 120. So it's the maximum of 120, or if something material happens in that time, say you take an investment round, say you acquire a company, even just acquiring a really important new customer, anything that has a material impact on your company could change the valuation, and the valuation would no longer be valid. So it's quite important actually, once you get the valuation, to get the options issued as soon as possible. Then the most important part is within 92 days of granting the options, they have to be notified to HMRC. It's basically an online form that you have to submit. It goes through the pay-as-you-earn portal on HMRC online services. It takes about 10 minutes to complete maximum, depending on how many employees there are. Actually, you might have quite a lot of typing to do. And it has to be submitted, screenshot and confirmation printed off, because again, it's so important for the future. If the options are not notified, then they are not qualifying EMI options. That means that they are unapproved. That means that your employee is not going to be very happy in the future, because they are going to have a pretty stinking tax bill to pay. This happens quite a lot. We have clients who come to us and say, oh, we're actually looking to go through a sale process, but I realised, and I've not told the employees yet, but we didn't actually notify their options. And at that stage, there is very little that can be done. We had a client recently who realised that he hadn't notified just one person's option. They already had other options, and then they'd done a top-up round, and the top-up round hadn't been notified to HMRC. We sent an absolute sob story to the inspectors to get what we call a reasonable excuse claim to be able to notify them late. We've applied for that before and have been told under no circumstances will you be allowed to have a reasonable excuse claim where you don't actually have, I don't know, my office burned down, or I was stuck in another country with no access to IT. It has to be something so severe. But because we could show that the individual intended to grant the options, there was other options granted at the same time, it was a case of human error. I think the inspector was in a really good mood, and they came back and let us have it, which was great for that client, but definitely not something to be relied on. And then if we're looking at share schemes, unapproved options, or any shares that are being issued to employees, we've got to think about a whole other regime called the employment related securities regime. Anytime an individual who is employed or is an office holder of a company receives either shares or options or some other security, a security could be something like a convertible loan note, then they fall within the employment related securities regime. There's a deeming provision, so if you have that relationship with the business, you are deemed to have received whatever it is by virtue of your employment. If they pay full market value, fine, there's no tax due, it's straightforward. They just have to be notified to HMRC in an annual return. We do, I can't remember how many we're doing this year, the list is so long. In previous years, we've maybe done 30 returns for different clients, and I think now they must be well up to about 75 or 80. Neil, is that right?
Yeah, that's about right. Plus we look at another 100 companies and decide they don't need.
Yeah. So we basically have to go through and check everything that's happened in all of our clients, and obviously staff are getting EMI options, staff are getting unapproved options, people are getting shares, maybe a new non-exec director is getting some kind of incentive. Everything needs to be reported. It's a big job, but it's also really important. It's basically a checking mechanism for HMRC to make sure that the individuals are putting the right information on their personal tax return if they've got a tax liability to pay, and also if the company is taking any kind of deduction for the difference in value, that it all kind of marries up. Now that is the end of my presentation. So I'm happy to take any questions that anyone may have. And I realise I've already run over time, I do apologise.
Oh, that was my fault for the technical issues in starting a couple of minutes late. That's I get the blame.
Well, if nobody has any questions, thank you very much, Tim. I'm really happy to take any questions over email. You'll be able to get my contact details shortly. And also, we have been doing some more simple overviews of the different schemes that we advise on, and they're available on the Student Tate YouTube channel. So if you want some more detail or you want to be able to refer back, then there's videos up on there as well. Perfect. Well, thanks very much for listening, everyone, and look forward to hearing from you all or meeting you at the virtual EIE.